So imagine waking up this morning to find that billions of dollars were just wiped out of the Asian stock markets.
Yeah, quite the morning.
Right. But, it wasn't a bank collapse and it wasn't a sudden war that made the tech sector hemorrhage cash. The global economy basically just tripped over a single 78-layer piece of plastic and copper.
I mean, it sounds almost absurd when you frame it that way.
It really does.
But that is exactly the reality of the global market structure we're looking at today. We tend to view the economy as this, highly resilient, shock-proof machine.
Yeah, like it can take a hit.
Right. But the events unfolding right now reveal this terrifying hypersensitivity, particularly inside the artificial intelligence infrastructure bone.
Right.
The entire system is balancing on the edge of a knife, and, well, today that knife slipped.
Okay, let's unpack this. For you listening, we're going to pull all of this apart. We've got a stack of fresh market analyses, financial reporting from Trading Key and the Business Times, and some incredibly granular tech breakdown reports.
All covering the events leading up to today, Wednesday, July 8th, 2026.
Exactly. Though, quick note, a few of the broader global sources we usually monitor were actually blocked by security firewalls this morning.
Yeah, which is frustrating, but
But the reports we do have access to are more than enough to paint a really stark, complete picture of a market in absolute turmoil. So our mission for this deep dive is to basically cut through the noise and the panic.
we really need to understand why a highly technical whisper about a printed circuit board triggered a massive regional market crash.
Right. And we're going to decode what NVIDIA's very specific, very careful public denial actually means. And most importantly, explore why this exposes a brand new era of physical fragility in the tech world.
So to understand the tech side, we really first have to look at the sheer scale of the financial bloodbath that happened today.
Yeah, it was brutal. We are talking about a historic trading session across Asia. Just to set the stakes for you, the KOSPI index in South Korea didn't just experience a little dip.
No, the selling pressure was so intense it actually triggered an intraday temporary trading halt.
A full halt. It ultimately plummeted 5.35% to hit 7,246.80, which is the lowest point we've seen since May 20th.
And the contagion spread immediately. Over in Japan, the Nikkei 225 fell 2.11%, dropping to 66,819.05. That's a new low since mid-June.
But I think the most revealing data is where the bleeding was actually concentrated, right?
Exactly. This wasn't a broad, even sell-off. It was a targeted strike on the memory chip giants. Samsung Electronics saw a massive 6.25% drop. That pulled its stock price below the 280,001 support level to close at 277,500.
Ouch.
And SK Hynix, another absolute titan in this space, they fell 5.68%.
So looking at those numbers, the instinct is to just blame the technology sector entirely, but the source reports point to a much more complex web of triggers today. There's a massive geopolitical component hitting the markets at the exact same time.
Yeah, it's a perfect storm.
Right. Early today, we saw a sudden outbreak of military conflict in the Middle East, and that was combined with news about the lifting of oil sanctions. Now, just as a reminder, we're just reporting what the analysts are saying here, not taking any sides on the geopolitical stuff.
Of course. But those geopolitical events, they act as the macro catalyst. To understand why a conflict in the Middle East crashes a memory chip manufacturer in South Korea, you have to look at how modern algorithmic trading works.
Right, the bots.
Yes. When oil sanctions are lifted, the market anticipates this flood of crude oil, which dropped energy prices. That sudden shift forces algorithmic trading protocols to instantly...
To recalibrate everything.
Exactly. They instantly recalibrate their inflation models and their risk weightings.
So the algorithms just automatically start pulling liquidity out of the market to reduce risk?
Precisely. They systematically drain capital from high-beta, volatile assets. And right now, that means emerging markets and high-growth tech stocks, they move all that capital into safe havens. And the sheer speed of that automated capital flight, it creates a massive liquidity vacuum. So you have this intense global geopolitical tension colliding perfectly with an overextended tech sector.
Which creates a knee-jerk panic.
Right.
But I do need to push back on that narrative just a bit, because there is a glaring contradiction in the trading data from today's session.
Okay, go ahead.
If these algorithmic trading models and the foreign capital funds are just indiscriminately dumping tech stocks because of the Middle East, why did we see a massive V-shaped reversal right in the middle of the trading day?
Ah, yes. the bargain hunters.
Exactly. The analysts note that amidst all the selling, bargain hunting capital rushed in specifically to buy the dip on AI hardware assets. Kioxia, for example, only ended up falling 0.73% by the bell.
Right.
So why is the quote-unquote smart money aggressively buying memory chip stocks when the rest of the market is supposedly on fire? Does this mean that AI hype is just bulletproof?
That V-shaped reversal is arguably the most telling part of today's session. It really exposes the current psychology of institutional investors. The smart money, the massive hedge funds and institutional buyers, they no longer view core AI hardware as a speculative, high-risk bet.
They don't.
No, they view it as a foundational core asset. It's very similar to how investors used to view utility companies or railroads back in the day.
So they see a geopolitical shock as, like, a discount event, not a structural failure of the tech itself.
Exactly. When foreign capital selling drives the overall indices down, these institutions, they don't see the end of the AI boom. They see a washout of weak retail hands.
Right, time to buy.
Yeah, they step in and buy assets like Kioxia and SK Hynix at a discount because their underlying conviction in the long-term necessity of AI infrastructure is incredibly strong. They know that regardless of what happens with oil sanctions in the Middle East, the world is still going to need high-bandwidth memory chips.
Which brings us to the specific tech rumor that poured gasoline on this already volatile fire.
Here we go.
We've established the market fragility, but the catalyst for the tech-specific sell-off actually originated over the weekend between July 4th and 5th. A research firm called Semi-Analysis dropped this highly granular report claiming that Nvidia's next-generation AI server racked the Kyber NVL144 is facing massive delays.
Yeah, potentially slipping from its planned 2027 launch all the way to 2028.
So to understand the panic, we need to break down what the Kyber NVL144 actually represents. This isn't just, an incremental upgrade.
Not at all. It is a system designed around NVIDIA's upcoming Vera Rubin Ultra GPU. The current generation of these systems, they pack 72 GPUs into a single server cabinet.
Which is already huge.
Right. But the Kyber NVL144 is designed to pack 144 GPUs into one single cabinet, operating as a unified massive computing platform.
The raw computational density of that is just staggering. But packing 144 GPUs into a single rack brings us to the bottleneck that Semi-Analysis highlighted.
The infamous printed circuit board.
Yes. The report claims the delay is caused by something called an orthogonal backplane. What exactly does orthogonal mean in this context? And why is it causing a multi-billion-dollar supply chain crisis?
So in traditional server racks, you have different circuit boards connected by hundreds of high-speed cables. But when you are dealing with 144 GPUs communicating at the speed of light, cables are just too slow.
Too slow and too bulky, I imagine.
Exactly. They take up too much physical space, and they actually block the airflow needed to cool the system down. So orthogonal means they are plugging these massive server boards directly into a central midplane at right angles, perpendicularly.
Oh, I see.
Yeah, no cables, the boards just slot directly into each other.
Well, that sounds incredibly efficient. So what is the problem?
The problem is the physical manufacturing of that central midplane. To route all the data for 144 GPUs without any cables, this printed circuit board needs up to 78 separate layers of copper and dielectric material pressed together.
78 layers. Okay, let's visualize what a 78-layer circuit board actually means in the physical world for you listening. Think of trying to build a 78-story skyscraper.
Okay.
But the catch is that every single floor has to be wired flawlessly to all the other floors. If just one microscopic connection on the 43rd floor gets slightly too hot and expands, or if the data signal degrades just a tiny fraction of a millisecond, the entire 78-story building is completely useless.
That analogy perfectly captures the physics problem here. Because when you press 78 layers of different materials together, they all expand and contract at completely different rates under the extreme heat generated by 144 GPUs.
Oh, wow.
Yeah, the microscopic copper via the little tunnels connecting the layers, they can literally tear themselves apart from the thermal stress.
Wow.
So maintaining signal integrity and thermal tolerance at that scale is a monumental engineering hurdle.
And because this market is so tightly wound right now, a rumor about this 78-layer bottleneck at the very top of the food chain just instantly crushed the suppliers at the bottom.
Oh, absolutely.
By Monday, July 6th, the collateral damage across Nvidia's Asian supply chain was just devastating. Japan's Ibiden, which is a major manufacturer of these high-end substrates, dropped as much as 10%.
Yeah.
In Hong Kong, kingboard laminates plummeted 18%. And over in South Korea, Samsung Electromechanics slid 11%.
And that market reaction
Mm-hmm.
really shows how front-loaded the capital investments are in this space. These suppliers, they've already spent billions retooling their factories to produce these massive 78-layer boards.
Getting ready for the order.
Right. If Nvidia pushes the order back a year, those factories basically sit idle. That destroys their revenue projections, which is exactly why billions of dollars in market cap just evaporated over a single weekend rumor.
Which, forces NVIDIA into a corner. They had to respond, and their public relations strategy here is
It
fascinating.
was very swift.
Very swift. Within hours, an NVIDIA spokesperson pushed back, stating, quote, "Our roadmap remains intact," end quote. They made a specific point to note that their current Rubin systems are already in full production and are on schedule to ship this fall to the major hyperscalers.
In Microsoft Azure, Google Cloud, and AWS.
Right. But the financial community immediately fractured over how to interpret those four words. Roadmap remains intact.
Oh, for sure. You had the bulls and the skeptics.
Yeah, Jim Cramer went on CNBC and took the most bullish stance possible. He called the sell-off misguided selling and actually urged investors to execute a revenge trade. His logic is pretty straightforward. If the company says the roadmap is intact, you take them at their word and buy the dip.
But the skeptics are definitely reading between the lines here. Daniel Newman, the CEO of the Eastern Group, pointed out that roadmap intact leaves a massive amount of room for interpretation. He did note that NVIDIA's fiduciary duty prevents them from outright lying to shareholders, but corporate PR is all about semantics. And Patrick Moorhead, over at More Insights, he called the statement generally encouraging, which, let's be honest, is hardly a definitive dismissal of the rumor.
Here's where it gets really interesting, though. Because corporate communications in the tech sector, like you said, they are heavily vetted by legal teams.
Every single word.
So look at the words. Our roadmap remains intact. Doesn't that just mean their ultimate long-term destination hasn't changed?
Right.
It absolutely does not explicitly deny a 12-month delay for this specific Kyber NVL-144 system. It just says, hey, we're still planning to get there eventually. Aren't the bulls just hearing what they want to hear?
They absolutely are, and it perfectly highlights the concept of execution risk in today's market. We are in an environment where expectations are so incredibly elevated. The market isn't just pricing in NVIDIA's potential success over the next 5 years.
It's pricing in perfection right now.
Exactly. Flawless, to-the-minute execution today. So when a stock is priced for absolute perfection, execution becomes the market's only anchor. Any whiff of a supply chain hiccup?
It just erases billions.
Yes, because the valuation leaves zero room for error.
And the stakes are astronomical because the semi-analysis report also claimed that NVIDIA recently scrapped an alternative back-to-back rack design. Apparently, their hyperscaler customers found it too costly and awkward to deploy.
Which leaves them without a plan B.
Right. So, if the big 144 GPU rack is delayed to 2028 and the backup design is in the trash, what do these massive tech companies do? They have hundreds of billions of dollars in capital expenditure budgets ready to deploy right now.
They cannot afford to wait. And that introduces the massive strategic implications of this whole rumor. If the undisputed king of AI hardware stumbles, even for just a moment, it creates a vacuum.
It's totally like the commercial airline industry. If Boeing suddenly announces a massive multi-year delay on their next-generation flagship jet, airlines don't just stop flying passengers.
Right, they can't.
They have routes to run and shareholders to satisfy. They immediately start looking at Airbus, or in the case of a company with unlimited resources like Google, they try to figure out if they can just build their own airplanes.
And the market data supports that shift perfectly. Look at AMD. Their shares are up roughly 158% year to date.
Wow.
Goldman Sachs actually just raised their price target on AMD from $450 to $640. And Goldman specifically cited strong customer engagement with AMD's MI450 series chips. So the market clearly sees that window opening for AMD to step in as the immediate alternative.
But Google is the ultimate wild card in this scenario, aren't they? They're in this highly unusual position of being both one of NVIDIA's biggest customers and a direct competitor in chip design.
Google's moving incredibly fast. Their cloud revenue is surging up 63%. But more importantly, their 2026 capital expenditure is guided up to an astronomical $190 billion.
$190 billion? That's insane.
It is. If NVIDIA slips on delivering the Kyber racks, it massively strengthens Google's internal mandate to rely on their own custom silicon, specifically their TPUs or tensor processing units.
Let's break that down for a second because, we throw around acronyms like TPUs and ASICs a lot. Why is Google building its own chips a threat to NVIDIA's general-purpose GPUs?
Okay, so a GPU is designed to be highly flexible. It can render a complex video game or it can train a massive language model. But an ASIC, an application-specific integrated circuit, which is what a TPU is, it's hard-coded into the silicon to do only one specific type of math.
So it's not flexible at all.
It is entirely inflexible. But for that one specific task, it is vastly more efficient and uses significantly less power. If Google knows exactly what kind of AI models they are running in their own cloud, they can build custom ASICs that actually do the job better than an off-the-shelf NVIDIA GPU.
And the money is already flowing in that direction. I mean, the reports note that Broadcom is benefiting hugely through manufacturing these custom ASICs. Their AI semiconductor revenue just hit $10.8 billion.
Which is a 143% year-over-year jump.
Unbelievable. So this feels exactly like the gold rush. If the supplier of the absolute best pickaxes runs into a manufacturing delay, the miners don't stop mining.
No, they don't.
They just start buying the second best pickaxes from someone like AMD, or they start forging their own pickaxes like Google. If the capital can't flow to Nvidia because they can't figure out a 78-layer circuit board, it's just going to flow to the path of least resistance.
The capital will flow, yes.
Yeah.
But we really have to ground this in the reality of data center architecture. The window of opportunity for rivals like AMD and custom silicon is incredibly tight.
Right.
NVIDIA still commands approximately 81% of the AI chip market.
81%.
Yeah. And a recent Guru Focus analysis actually flags NVIDIA as being 45% undervalued at its current price relative to its fundamental value.
So even with a 12-month delay, NVIDIA's moat is deep.
Very, very deep. Hyperscalers cannot just swap vendors overnight. You don't just unplug an NVIDIA rack and plug in an AMD rack.
It doesn't work like that.
No. The software ecosystem, specifically NVIDIA's NVDA platform, is deeply, deeply embedded into how these developers work. Switching requires massive infrastructure overhauls.
Which brings up a completely unexpected twist hidden in these source reports. A faction of market participants are actually arguing that a delay of the Kyber NVL144 might be a good thing for the industry as a whole.
It is a really fascinating counter-narrative. We are currently facing severe chronic power shortages globally when it comes to expanding these AI data centers.
They just use so much juice.
They do. These 144 GPU racks draw a staggering amount of electricity. The physical power grid literally cannot keep up with the tech sector's ambitions right now.
So a hardware delay naturally synchronizes with the physical constraints of the utility grid. I mean, we don't have the power to plug these monster systems in anyway.
Right.
If they arrive a year late, it actually gives the utility companies time to lay the copper wire and build the substations required to actually turn them on.
Exactly. It highlights how the physical world has become the primary speed limit for the digital world. The bottleneck isn't the software engineers writing code anymore. It is the physical extraction of copper, the upgrading of the power grid, and the literal laws of thermodynamics preventing a 78-layer circuit board from melting.
Wow. So what does this all mean for you listening as you watch this unfold? If we distill this entire deep dive down, the core takeaway is a lesson in extreme physical fragility.
Absolutely.
We just watched a single rumor about the manufacturability of one component. A circuit board mid-plane exposed the immense hypersensitivity and the astronomical expectations propping up the AI hardware market. It's a market priced for absolute perfection, where a semantic debate over the word intact can swing global indices and wipe out billions in value.
And moving forward, if you are trying to gauge the actual health of this market beyond the weekend rumors, you need to watch the immediate horizon carefully. The sources point to two major upcoming events.
Okay, what should we be looking out for?
First, this Friday, SK Hynix has its upcoming U.S. listing. The pricing performance there will act as a crucial bellwether to see if Asia-Pacific semiconductor stocks can shake off this volatility and, launch a second wave of bullish momentum.
Right. And second, next Tuesday, Samsung releases its earnings report. If they show any signs of structural weakness, or if their executive team confirms any supply chain bottlenecks on the earnings calls,
we could see another massive wave of institutional selling.
the short-term washout we saw today might be nearing an end as the bargain hunters stabilize the floor. But the underlying tension, the massive execution risk embedded in this next leg of the AI computing cycle, is now permanently priced into the market's consciousness.
Investors are finally realizing that building the future is a lot messier than just drawing it on a roadmap.
Yeah, they really are. We spend so much of our time worrying about the philosophical and the science fiction scenarios, right? We debate whether artificial intelligence will outsmart human beings or if algorithmic trading will destabilize the global economy. But what if the ultimate ceiling on AI isn't the software? What if the true limit to the AI revolution is just basic physical plumbing? The simple, humbling inability of humans to manufacture a physical piece of fiberglass and copper that doesn't melt under the immense heat of our own ambition.
It's a sobering thought.
Something to think about.